The big headline this week: the Fed cuts the Fed rates fund by 25 basis points to a range of 3.5 to 3.75%, the third cut this year. While this rate only applies to overnight lending between banks, it still influences borrowing costs across the economy, including mortgages. That said, the decision wasn't unanimous. Governor Stephen Moran pushed for a larger 50-point cut, while Kansas City's Jeffrey Schmidt and Chicago's Austin Goolsbee preferred to keep rates unchanged. Their split highlights the Fed's challenge of balancing stubborn inflation with signs of a cooling job market. Chair Jerome Powell also set the bar higher for another rate cut next quarter, explaining that the Fed is now in the upper bounds of neutral. In other words, there isn't much room to cut much further unless inflation falls or the labor market continues to weaken. One additional surprise from the meeting: the Fed announced it will begin buying $40 billion per month in Treasury bills starting today, Friday, December 12th. While this move does not directly impact longer-term rates like mortgage rates, it could help if the Treasury shifts towards issuing more short-term debt and less long-term debt, easing pressure on the bond market. All of this data impacts rates by the hour. A rate dip can show up quickly and just as quickly disappear, which means if you're sitting on the fence thinking about buying or refinancing, you're probably not positioned to take advantage of it. If you're waiting to see a specific rate hit the news, you'll miss it. Fortunately, you can position yourself to take advantage of a rate drop. Most people don't even know what rate they need to jump in at, but once we talk through the results you're looking for, we can pinpoint what rate will get you there and be ready to move when the window opens. If you're thinking about buying, refinancing, or just want to understand your options, let's connect. I'm Leah with USA Mortgage, and I will see you in the next video.